Hi, everyone. Merry Christmas and a Happy New Year in advance to you. Welcome to the stream today. Really excited for having you on the stream as we continue with our discussion towards the March 2026 examination. And on the stream today, we're going to be focusing on some accounting standard issues and also looking at ethical issues critically important for financial reporting students and corporate reporting students or strategic business reporting in ACCA as well. And we want to get excited and look at some practice questions as we go into the discussion. I see some of you guys joining. Welcome. If there are any questions you have, something you want me to share my thought on, put it in the comment section or the chat for me, and I'm going to be answering your questions for you. And then if there are any topics also that you want me to cover on the stream, so maybe there is a topic, don't give me subject, topical area that you want me to cover on the stream, or certain questions that you want me to look at, put it in the comment section or the chat for me, and I will really be excited to answer and cover that in the next episode as we continue with the discussion. Also, make sure you share the video. Let's reach as many people as possible. So if you are watching, you can share the video on your WhatsApp groups, on your Facebook groups, on your Telegram pages. And let's get as many students as possible joining and watching the stream so that we can together help as many people as possible. Give me a sec. Let's see if I can pull this up quickly. Just bringing up our TikTok feed as well here. So I believe that you are enjoying your holidays. 2025 has been a great year for you generally. And in the midst of all the enjoyment, I hope that you are also preparing for the examination coming in March 2026, because it's going to be here pretty soon. And one thing that I want to quickly share with you is that in case you have not registered and you are thinking about registering and asking yourself, hey, Nhyira, is it too late? Can I start studying now? Will I be able to make it? Yeah, we still have some time to go. So it's not late. You can you can still register to start studying now, because the most important thing is being able to put yourself in the position where you can discipline yourself, expose yourself to as many questions as possible so you can have an understanding of what is going on generally in the syllabus. So is it too late to start studying for the March 2026 examination? If you ask me, I would say no, it's not too late. You still have some time available that you can leverage or use to put you in the position to go into the exam hall and pass the examination. So in case you want to register, you can visit our website, nhyirapremium.com, or you can send us a message on WhatsApp, 050-114-9296 in that case. So what we want to look at today is IAS 38, intangible assets. We're going to be solving some questions in respect of that, and also ethics. And that is also an important topical area in financial reporting as well as corporate reporting, or SBR, strategic business reporting. So let me bring up my screen quickly and let's begin our discussion for the day. There we go. So we are looking at the ICAG March 2024 past question. So you can download this from the ICAG website, March 2024. We're going to be looking at some of the questions in there for financial reporting here. Just before we go, it's always important to understand what the chief examiner has mentioned in the past and what students are supposed to know about. So here, the chief examiner made a comment here that a great number of candidates demonstrated lack of understanding of how to apply the respective IFRS in the preparation of financial statements. And this is a common theme when it comes to financial reporting and corporate reporting, strategic business reporting. It is always the accounting standards. And so your ability to understand the accounting standards will help you to put you in the position to ultimately pass the examination. So as a student preparing for financial reporting, corporate reporting, strategic business reporting, you must make sure that you really understand the standards. And that is what we are going to be doing as much as possible during these sessions, trying to draw your attention and crystallize some of the fundamental principles when it comes to the accounting standards. So as I mentioned, I see some of you guys joining. You are welcome. We are looking at IAS 38, intangible assets and ethical issues, financial reporting, corporate reporting. If there are any questions, put it in the comment section or the chat for me. And also, share the video. Let's reach as many students as possible. So ICAG, March 2024, Professional Examination, Financial Reporting, Paper 2.1. We are going to question 2C. Question 2C. Question 2C. And that is in total 7 marks. And the requirement here is, in each of the scenarios I to III above, in each of the scenarios I to III above, recommend the appropriate accounting treatment for the year ended 30th November 2023 in accordance with IAS 38, intangible assets. And so quickly, we need to really call on our principles when it comes to IAS 38, intangible assets. Now, intangible assets are simply non-monetary assets without physical substance. And we have examples of intangible assets like copyright, patent, development cost. Okay? All these are franchise. All these are examples of intangible assets. When it comes to the initial measurement, the initial cost of an intangible asset shall be the purchases cost plus all other directly attributable costs incurred in bringing the intangible asset to present use. Then generally, another thing we must understand in respect of the intangible asset is that on subsequent measurement, the accounting for intangible asset depends on whether they are monetary items or non-monetary items. Or let me put it this way, intangible assets, that's a mistake. Let me take that again. The subsequent measurement of intangible asset depends on whether they have definite economic useful life or indefinite economic useful life. So the intangible assets with definite economic useful life, we are going to amortize the cost over the economic useful life of the asset. That is it. That's all. But intangible assets with indefinite economic useful life, like goodwill, those ones we are going to be testing for impairment annually. But then the standard also gives room for some key issues that you need to understand, like research expenses. All research expenses must be written off. However, development costs may be capitalized, depending on whether the capitalization criteria is met. That is, capitalization criteria are met, which is sector. So we will capitalize development cost. If it is a separate project, we can reliably estimate the cost. There is a commercial value, meaning there is a ready market. It is technically feasible, meaning that we can actually execute and do it. It is overall profitable because we are not just here to launch something or introduce something in the market and go away. And R means there is resource available to complete. So if we can see some of these things in a given question when it comes to capitalization of development cost, you may not see all of them, but we need things such as commercial viability, maybe resource available to completion, and technical feasibility. One of these three, when present, we can then conclude that, okay, that development cost should be capitalized. Now, when development costs are capitalized, they are going to be amortized over the economic useful life. We don't remeasure development cost or carry development cost at fair value. It will always be carried at the historical cost, less any amortization that we are going to be charging. So that is what you must understand when we talk about development cost as well as research expenses. Then goodwill. It's another thing that the standard throws more light on. When it comes to goodwill, we can recognize goodwill arising from business combination. So you remember this in consolidated financial statement, that where the consideration, the difference between the consideration transferred and the net asset of the subsidiary at the date of acquisition gives us goodwill. And that is pretty simple in respect of that. And we can have a positive goodwill or a negative goodwill depending on where exactly we are standing. But that is the idea about goodwill. But internally generated goodwill cannot be recognized. So the entity cannot by itself do any workings internally and say, oh, this is the amount of goodwill they are recognizing in their books. No. Goodwill arising from business combination is what we recognize. So these are a number of thematic issues, concepts, principles that we must understand when it comes to IAS 38, intangible assets. Now, with that refresh at the back of our mind, let's come back to the question here, ICA Financial Reporting, March 2024 past question, and we are looking at question 2C. Question 2C. Again, let's look at the requirement. In each of the scenarios I to III above, recommend the appropriate accounting treatment for each for the year ended 30th November 2023 in accordance with IAS 38. It is always important to understand the active verb that the examiner is using. Here it is recommend. So since the active verb here is recommend, it means that you are going to be speaking English. Because if you are going to make a recommendation, then you need to write and make some expressions. So you are not just going to be doing calculations and going away. No. Where there is a calculation, you do it. Then you must also explain what you are doing. It's always important to understand the active verb and what the examiner is requiring by the verb in the question, because if you miss the verb, like it is recommend, you only do the calculation without the explanation, you are leaving maybe half of the marks on the table or 2/3 of the marks on the table, depending on the marking scheme. So here, recommend, we are going to be speaking English a little bit. So let's go back. Mankini Limited, Mankini, is one of Africa's leading entertainment companies which creates and secures the right to phenomenal content from all over the world. Mankini has entered into the following transactions during the year ended 30th November 2023. Again, we are going to be interested in the year ended because that is crucial for our discussion. So let's look at the I. On 1st December 2022, wait. If our year ended is 30th November 2023, that means the year starts on 1st December because November, then you go to December. So 1st December 2022 is at the beginning of the year. Mankini purchased the sole West Africa distribution rights for a special digital set-top box for home entertainment. The rights were purchased for 5 million or 5.25 million over a 3-year period. Okay, so how do we account for this? The rights they've purchased is an intangible asset. So let's see how we account for this. So Mankini Limited, I, purchase of digital set-top box, because I want to just put a name up. Purchase of entertainment right. So let's go. This is an intangible asset. So we go to initial recognition, which is on the 1st of December 2022. They bought it for 2.25. So we can pass a journal entry to then say that we debit intangible assets, that's what we are buying, 5.25 cities, and then we credit maybe cash or bank 5.25. Okay? Now, this is an intangible asset with a definite economic useful life because we are buying it for 3 years. So if it's an intangible asset with a definite economic useful life, what does that mean? It means the cost of the right must be amortized over the 3-year period. So this is an intangible asset with a definite economic useful life. And must, with a definite economic useful life. So the cost must be amortized over its economic useful life of 3 years. Again, context of the question, recommend. So we are not just going to be doing calculations here. We are going to be writing some English in between to explain what is going on. So now at 30th November 2023, if you check the date carefully, they bought the thing on 1st December 2022. So at 30th November 2023, it's a full year. So we're going to be charging a full year amortization to P&L. So charge to profit or loss, which is the amortization, will be the 5.25 million divided by 3 years. All right? 5.25 million divided by 3 years. So let's see, what do we have for it? 5.25 divided by 3, and that is 1.75 million Ghana cedi. So again, we are charging that to profit or loss. If I like, I can throw in my journal entry, and that is to debit profit or loss. 1.75 million, and I'll credit the intangible asset. The same amount, 1.75 million. So at the reporting date, the carrying amount that will go to the profit or loss will be the difference. So carrying amount will be the 5.25 million Ghana cedi minus 1.75 million Ghana cedi. What do we have? 3.5 million Ghana cedi. So this is the answer to the I part of the question for 3 marks. 3 marks. And that is something I keep on telling you. Speed and accuracy is going to be crucial in the exam hall. So when you are working yourself out, speed and accuracy is crucial in the exam hall. But that is the I aspect of the question. They bought a copyright. It's an asset with definite economic useful life. So we amortize it over the 3 years. Let's go to the II part of the question. It says, Mankini started working on building the brand and increasing sales of the items mentioned in I above on 1st December 2022. Due to the enormous success of this endeavor, the Mankini brand became popular. Mankini wishes to include the brand in its financial statement for the year ended 30th November 2023. at its estimated fair value of 30 million. Now, if you pay attention to this is an internally generated intangible asset. And as per the standard IAS 38, internally generated intangible assets cannot be recognized in the financial statements. So the entity cannot say, oh, because they have started building the brand, whatever it is, they want to include that brand in the books of the entity. It's not possible. That is internally generated intangible asset. So it cannot be recognized in the books. Now, all the costs associated with building the brand, those costs must be expensed in the profit or loss account for the year ended under review. Period. That's all. That's all. So we don't care whether they have given us the fair value of 30 million for the Mankini brand. The Mankini brand cannot be put into the books because it is an internally generated intangible asset. So II. So as per the guidelines in IAS 38, an entity is prohibited from recognizing internally generated intangible assets in this case, the Mankini brand. Is prohibited from recognizing internally generated intangible assets. In this case, the Mankini brand in the financial statement. On the basis of the above, the fair value of 30 million Ghana cedi relating to the Mankini brand cannot be recognized in the financial statement. Are you getting it? Cannot be recognized in the financial statements. Okay? However, any cost incurred in the building of the brand must be expensed in the profit or loss. This is what we are talking about. So, internally generated goodwill cannot be recognized. So, it is like we are preparing the financial statement for our organization. Then we say that, oh, Nhyira Premium, the brand name Nhyira Premium is, powerful, right? We have a lot of influence, subscribers, followers across all social media platforms. So the Nhyira Premium brand, if we look at it, we can value it at maybe 10 million Ghana cedis. So let's put that 10 million Ghana cedi in our books. No, you cannot do that as per IAS 38. Now, this is different from if you directly register the trademark. That's different. You go register the trademark and do everything, and it can be separately sold. Then it could be recognized. It will be recognized. Do you get the idea? So the reason why we are not recognizing this internally generated brand is because it is not separately identifiable. You cannot sell Mankini on its own. That's the idea. So if it is separately identifiable, then it could be recognized in the books of the entity. But that is the second thing here. Internally generated intangible assets cannot be recognized in the books of the entity. Any questions for me? You put it in the chat for me or the comment section, and I'm going to be answering that. Let's look at the last one, III here. The III says, Mankini wishes to replicate its West African success in Eastern African countries by selling the product in other markets. The company has spent $1.25 million during the year researching the Eritrea market and wishes to capitalize this expenditure as an intangible asset. No. Research expenses in accordance with IAS 38 should be written off, not to be capitalized. So certainly the 1.25 million Ghana cedi incurred in researching the Eritrea market cannot be capitalized. It must be written off in the profit or loss. So 1, 2, 3. IAS 38 requires that research expenses incurred during the year should be expense, or if you want, written off and not capitalized. All right? As such, the cost of 1.25 million Ghana cedi incurred during the year researching the Eritrea market. Did I get that Eritrea well? Yeah. Eritrea market should be recognized in the profit or loss. And not capitalized as wished by the entity, if I can put it that way. Or let me say as required by the entity. Just trying to write the English well. Okay? Because everything we are doing, because of the context of the question, it says recommend, right? Recommend. So everything we are doing, we are writing English. So you need to be, careful of your expression that, you sound a little bit grammatically good, generally. And this is where sometimes my students will say that, accountants don't understand English. It's a lie. All right. So sometimes I'll be talking to my student and they're like, Nhyira, you should understand that accountants don't understand English. Who told you that? What are you learning in? Are you learning in Greek? No, you are learning in English. So why do you tell me you don't understand English? Now, normally I understand the challenge will be, okay, if it was calculation, you could have done it easily. But now that you're supposed to just express that, then it becomes a challenge. But the reason it becomes a challenge is because, okay, your English is not good. But if your English is good and you understand the standards, you can gladly express yourself and you will get a full marks that you're supposed to get. So IAS 38 requires that research expenses incurred during the year should be expensed or written off and not capitalized. As such, the cost of 1.25 million Ghana cedi incurred during the year researching the Eritrea market should be recognized in profit or loss and not capitalized as required by the entity. So this is the answer to the question for 7 marks. Remember, as per the guiding principle, a mark is 1.7 or 1.8 minutes. So 1.8 times, there are 7 marks in total here. And so we are supposed to do this in 13 minutes, give and take. 13 minutes. The active verb here is recommend. All right? So this is the answer to the question, and that is IAS 38, a styling of the question. Not a lot to be done here. There are more complex IAS 38 environments that the examiner could take us to, but this is 7 marks on IAS 38, 3 key scenarios, and the examiner is just combing through the standards to find out whether you're good or you are not good. Any questions, you put it in the comments or the chat for me. So that is Mankini Limited, slide 1 on that. Then the second slide, which is the I and III. All right. So let's go to the second part of our discussion, and that's going to be an ethics-related question. Still in that same March 2024 financial reporting ICAG, we are in question 5, and we are going to look at question 5A. Question 5A. For 5 marks, again, this means you are going to be using 1.8 times 5, 9 minutes. So we are supposed to do this in 9 minutes. Advise Esther on the appropriate actions to take. Advise Esther on the appropriate actions to take. Now, normally questions like this are going to be in respect of the behavior of the accountant. And so it means we are in the ethical issue, ethical realms in this case. But advise Esther on the appropriate actions to take. Let's see. Esther is a chartered accountant who works in a team that reports to Ameka, the finance director of Novak Limited. Ameka is also a chartered accountant. Okay, that's a good thing. Esther is a chartered accountant, reports to Ameka, who is also a chartered accountant. He has a domineering personality. Ooh. Domineering personality. So from an ethical point of view, this is an intimidation threat. Okay? This is an intimidation threat from an ethical point of view. Because if someone is domineering, it means that they're going to put undue pressure on you to do things that you are not supposed to do. And that domineering nature of the person intimidating you, causing you to do things you are not supposed to do, means you may breach the ethical principles of objectivity. And then, if you're not careful, you will end up associating yourself with financial statements that may be misleading, which is breaching the ethical code of integrity. Now, that means that you are not going to do your job in the manner that is supposed to be done, so you are breaching the principle of professional behavior, and you won't do the work in the manner that, again, is supposed to be done well, so you are breaching the principle of professional due care. I hope you are getting the way ethics is knitted in financial reporting, corporate reporting environment, SBR environment. That's what's happening here. So one character of the person domineering exposes Esther to an intimidation threat. That intimidation threat may put undue pressure on Esther to be biased, and that will influence her professional judgment in the preparation and presentation of the financial statement, which may result into misrepresenting items in the financial statement, and that is a breach of the principle of integrity. By virtue of that whole thing, it means that Esther will not carry out his work as required, breaching the principle of professional behavior and definitely the principle of due care. And that's the beauty of the ethical principles that you must understand. Let's continue to read. Remember, the question said, advise Esther on the appropriate actions to take. So I am adding some things because we are having the discussion here in class, but we are just going to be interested in what we will advise Esther to do. The reason I went that route to explain the intimidation issue and link it to the ethical code of conduct is because we could have a question like this and the examiner will put it blank like, what is the ethical issue facing the accountant and what actions should we take or should the accountant take? So in that case, it becomes a double-edged question. Here, we are just doing the action part. We are not interested in what problems the person is literally facing at the end of the day, although we can bake it into our answer intelligently. Novak Limited revalues commercial properties in line with IAS 16, property, plant, and equipment. Valuation information received last year showed that the fair value of the property portfolio was 2% less than the carrying amount of properties, with no single property being more than 4% different. A downward revaluation was not recognized on the grounds that the carrying amount was not materially different from the fair value. Okay, so this was what happened last year. They applied the revaluation model. They've revalued the assets. The fair value was 2% less than the carrying amount, which means there is an impairment, there is a revaluation loss. But they didn't recognize last year. Okay, let's see the final paragraph. This year revaluation shows a continued decline in the fair value of the property portfolio. It is now 5% less than the carrying amount of the properties, with some properties now being 15% below the carrying amount. So in the current year, we are still seeing an impairment. Esther submitted workings to ACCA in which she had recognized the downward revaluation in accordance with IAS 16. ACCA has sent Esther an email in response in which he wrote, "Stop bothering me with this rubbish." Imagine receiving an email like this from your boss. "Stop bothering me with this rubbish. There is no need to write the properties down. The fair value of the property is only 5% different from its carrying amount. Restate the numbers immediately." So this is confirming the intimidation threat issue that we spoke about at the beginning of the discussion. So what will you advise Esther in this case to do? Certainly, there are a number of actions that we can advise Esther to take. Number one is to have a meeting with the director, and because the boss is also a chartered accountant, the finance director is also a chartered accountant, he has to explain to him that he is under obligation to apply the accounting standards the way they have to be. So that's the first thing, explaining to. So let me see if I can put some appall here. So Esther, number one, Esther should have a discussion with the finance director. You write that in full, explaining the consequences of the misapplication of the fair value model in accordance with IAS 16. That's the first action she can take. But there is going to be something. So imagine this is the email your boss sent you. Stop bothering me with this rubbish. Then you text or you email your boss back and say, sir, I want us to have a meeting. Then your boss said, okay, jump on a Zoom call. Then you say, sir, I'm sorry, but what you are suggesting that I should do is against IAS 16. It will be a misapplication of the accounting standards. We cannot do this. It's not the right thing to be done in that regard. Imagine what your boss will tell you. Who are you? When I was a chartered accountant, you were in Pampers. Your mother has not even met your father. You are here advising me on what is a misapplication, what is a non-misapplication. So it's likely that Esther is not going to have the first action easy with the boss. So what can Esther do? We go to the next step. If the entity has an audit committee, Esther can escalate the issue to the audit committee. But here is the deal. Esther is not going to disclose what the finance director had told him to do. Because it's not like you are reporting your boss to the audit committee. If you do that, you'll be out of job because Agbalagba will come after you. Do you know Agbalagba? Agbalagba is, my daughter, Menana, you are gone. So the second step is seeking advice from the audit committee, if they have one, on how the subject matter to be dealt with, without disclosing what the finance director had asked her to do. That's the second action she can take. So she can seek advice internally from the audit committee or any equivalent body as such on the subject matter without disclosing the recommendation of the finance director. This is the principle of confidentiality. When you are seeking advice from people, whether internally or externally, you must make sure that you are not disclosing any information. Material. Again, you are not reporting your boss because Agbalagba can come after you very easy. You don't want to be Agbalagbet, so you have to be careful. Now, this is the second step. Now, chances are the audit committee or any equivalent body like that may be in bed with the finance director. So they may tell you that, okay, we don't think this is a good thing. Haven't you been told by the finance director what you're supposed to do? And you're bringing this thing here? What are you looking for? Children of this day, when your elderly tells you something, you are doing something else. Why? All right. In that case, if this will not work, then we go to the third step. The third step is that she can go outside the organization to seek professional and or legal advice on the subject matter. Again, it depends on the materiality of the issue we are talking about. Okay? So if this fails to resolve the misunderstanding, she can obtain both professional and legal advice from externally, bearing in mind the ethical code of confidentiality. So, like the Institute of Chartered Accountants has the professional ethics committee there, an equivalent body like that there, available for other professions as well. And you can go before them to seek advice on what you're supposed to do. Because remember, the professional accountant must not be associated with any misleading financial statement. So your boss is saying, this is rubbish. When I started and I became a chartered accountant, you were in Pampers. As a matter of fact, your father had not met your mother to give birth to you to now come and give me advice. You know the way this part of the world people do position, right? Like sometimes an elderly person is talking, it'll be like, look at this small boy. Look at this small boy. And they are referring to a 40-year-old man as a small boy. Audit committee, the issue did not resolve, so you can go externally to seek advice. Now, the reason you are seeking both professional and legal advice is because assuming it doesn't work and you are walking out, what are your chances? And because this is where the fourth thing comes in. After that advice, the last result, if things don't work, is to resign. So the last result is for Esther to resign. Okay? If the finance director refuses to implement the change, you resign. But here is the catch. Maybe the reason why the finance director doesn't want the financial statement to have revaluation surplus, any impairment, is because of an outstanding loan where maybe if the gearing position of the entity falls below a certain threshold, it will trigger the lender to request that payment be made. Or maybe the entity is preparing to go for a loan from the bank, and so the financial statement must have a certain position before they take their loans. And so you cannot be associated with that. So last resort, you resign. But here is the deal. Are you resigning to keep quiet, or you are resigning to go and tell authorities about it? That is why the fourth step, that legal action or legal advice, is very important. Because you cannot just get up and say, yeah, I've resigned from this company because they don't want to prepare their financial statement the way I want them to prepare. Okay, it's a good thing. But this is the question. Are you resigning to keep quiet, or you are resigning to go and spread the word? Because the entity can take a legal action against you if you resign. That is why before the resignation, you must seek legal advice to find out what are the options, what must you do. So in most cases, you can resign and maybe sign an NDA. But then there is a last aspect available. Sometimes, after that legal and professional advice, Esther may want to report the issue to maybe the appropriate authority. So, for instance, a bank misrepresenting its financial statement and sending fraudulent reports to the Bank of Ghana. And you are the accountant of the bank. And this is what your finance director and your bosses and the board are asking you to do. You cannot be in that environment. You need to resign. But after resignation, you must tell whistleblowing to the Bank of Ghana that, hey, the reports they've been sending to you are all cooked reports. How do we know this? Look at the banking sector cleanup exercise. Many of the banks, they were just cooking the financial statements, sending wrong reports to the Bank of Ghana. And the funny thing was that there were accountants in these companies colluding with the board, colluding with the management, cooking the financial statements. And auditors also came. Unfortunately, auditors also said they didn't see it. And that was why many of those banks that collapsed, just cooking on creative accounting and window dressing in the financial statement. So Esther resigned. But if you resign, you got to go report it to the regulatory authorities. But again, if you're going to whistleblow, you must know where you are standing. Because whistleblowing is a good thing. Reporting a wrongdoing to the authorities is good, but you got to be careful. Because especially in our part of the world, if you're not careful, you could be blacklisted. You will never get a job from anywhere again. If you're not careful, Agbalagba will come after you. Because you want to bring a whole company down at the expense of your integrity. Who the heck are you? But these are some of the things that we can talk about in respect of this particular question. So for 5 marks, these are some of the actions that Esther can take to address the domineering nature of the boss and the recommendation that the financial statement should not be prepared in accordance with the applicable financial reporting framework. Any questions? That is ethics, 5 marks that you must understand. It's an area that the examiner can bring in the exam hall that we need to be mindful of when it comes to dealing with financial reporting, corporate reporting, strategic business reporting. Ethics is fundamental. And so that is why, although this question is just about the actions Esther must take, I took you behind to tell you about the ethical issues in the question. Then we come to the actions that can be taken by Esther under those circumstances. And this is how ethics is going to be in corporate reporting, financial reporting, strategic business reporting. In advanced audit and assurance, ethics is different. The way we approach it will be different. Because if Esther was the auditor and has identified this, the way we go about it will be different for the answer, and the questioning will be different. Strategic case study, there is ethics there. That plays to the write-up will be different, the structuring will be different. Advanced taxation, there is ethics there. The write-up is going to be different. So these are some of the things you must understand, and that is what we want to bring to your attention on the stream today. So IAS 38, intangible assets, and then ethical issues. Any questions for me? Put it in the comments or the chat, and also remember to share the video. Let us reach as many students as possible watching the stream as well as the playback of the stream. Remember that you can still register to get access to our full lecture videos and join our community to study. Get access, joining our live lectures, getting access to our key summary videos, studying directly under my mentorship, being guided. Imagine you are getting access to guidelines and materials like this. how will your studies be like? You're going to be better. You will understand the thing well. You will know how to write out your answers well. Most importantly, you will know the context and structure of questions. And as you get yourself into the exam more, you'll be in a better position to ultimately pass the examination. So I'm going to wrap up around here today. And we're going to meet on the next session. Remember to like and subscribe in case you've not subscribed to the channel. Remember to like and subscribe and check the channel because we have a lot of content even on YouTube that you can get access to help you to pass the examination. Also, remember to download the Nhyira Premium mobile application on the Google Play Store or the Apple App Store. You download the Nhyira Premium mobile application. In the application, we have access to some free content available that you can also use. Then you can also get access to our premium content that are paid content, key summary videos, questions, and things to help you to prepare well for the examination and most importantly, pass the exam. So let me see. I think I have this here. TF Media said, good evening, sir. Yeah, good evening, TF Media. Then, okay, I don't know this name. He said, is this starting? Okay, yeah. I think that was at the beginning of the stream or before the stream commenced. What else do I have? Give me a sec. Let's see if I can pull up these. I think I'm seeing some questions here. Okay, my TikTok is not pulling up. I don't know why. Jayish Bajaj said, good evening, sir. Good evening, Jayish. Forgive me if I don't pronounce your name well, okay? I hope you're doing well. Thanks for joining us on the stream. Any questions, you put it in the comment or the chat for me before I get excited and say goodbye. Seth Boahin Ewuku on TikTok. Thanks for joining the stream. I think you've been on for some time now. Thanks really, really for joining and the thumbs up. Really appreciate it. Seth. Okay. I don't know. I can't pull up my TikTok chat. The overlay is just not working. I don't know why. All right. Okay, so I'm going to wrap up here today. We have our live public sector accounting and finance lectures coming up in the next 29 minutes. We are in session 3 for public sector accounting and finance. The journey has been interesting so far. So, as I mentioned, if you want to join our live lectures to study, you can send us a message on WhatsApp 050-114-9296 or visit our website. Check the description of this video if you're on YouTube or any other platform. The description of this video, the first link, take you to our website. Check out our course. If there are any questions you have, send us a message on WhatsApp. Let's assist you so you can prepare well for the examination and most importantly, pass the exam. Stephen Aguma, forgive me again if I don't mention your name right, okay? Stephen said, I appreciate you for this session. It's a pleasure. Thanks, Stephen, for joining us on the stream. Really appreciate you as well for taking the time to join us. On Facebook, Kakpa Andrew said, good evening, sir. The lecture was good even though I was having issues with my network. How can I have access to the record of this lecture? It's available. You're on Facebook, so after the stream ends, it's available on the page you can watch. But you can come to YouTube as well. It's on the YouTube page. You can watch it. The same name on YouTube. You can get access to the content as well on our YouTube channel. So it's available and you can watch the playback definitely after the stream ends. And this is also going to be available on our podcast platforms. So wherever you get your podcast, you can search for Nhyira Premium. And we are really adding a lot of audio lectures and other content on our podcast platforms. So wherever you get your podcast, Apple Podcasts, Spotify, Amazon Music, or wherever you get your podcast, just search for Nhyira Premium, the same name, search for Nhyira Premium, and you will see our podcast there. You subscribe, you follow, you like, and you get access to some of the audio lectures so that on the go, wherever you are, you can be listening to something as well to prepare you for the examination and pass the exam. So in addition to getting access to the lectures, the content, the videos, you can also subscribe to our podcast on any platform you are listening to podcasts on, and then just search for Nhyira Premium, get our podcast, and get an audio version of all of these lectures so you can prepare well for the examination and pass the exam. So thanks for watching. Thanks for sharing. Thanks for the thumbs up. Really appreciate. And stay connected. I'll see you on the next one as we continue with our discussion for the March 2026 examination. Stay safe, and I'll see you on the next one.